Hello and welcome to the AIM Summit webinar. I'm your host, Zachary Seferati, and I'm happy to help to be welcoming you to our session today on the 2021 Investor Playbook, how great change will bring great opportunities for traders. As I said, Zachary Seferati, I'm the CEO and founder of Dalma Capital and strategic partner of AIM Summit. We have so many people joining us today, people from over 75 different countries. Amongst you are institutional investors, sovereign wealth funds, family offices, high net worth, ultra high net worth individuals, and many leaders of the financial services industry. Thank you so much for dialing in and for joining us on this session. Please feel free to submit your questions throughout the session. There's a dialogue at the bottom of your screen called Q&A or question and answer. Please submit them at any time. We're going to be taking questions towards the end of the session after a brief fireside chat. If you're joining us after the fact on YouTube, please like this video and subscribe to our YouTube channel now. Sign up at aimsummit.com so you can be part of live sessions and engage in the Q&A with speakers like the star that we have with us today. First, I'd like to introduce our webinar partner today, Equity Group. Equity is a pioneering firm and world-class provider of online trading technology and multi-asset financial products. The group is globally regulated brokerage with 6 financial licenses, including FCA in the UK and SCA in the UAE, offering a wide range of top global equities, indices, commodities, and precious metals and FX. Also introducing my co-moderator today, Gaurav Kashyap. Gaurav is the head of futures trading at Equity Group. He set up 3 different trading desks and was instrumental in launching MetaTrader 5 on the Dubai Gold and Commodities Exchange, the first ever for the platform globally. As a financial commentator with a focus on global macroeconomic issues, he conducts market research and analysis for distribution amongst in-house clients, as well as providing regular market commentary to various international and local outlets across television, radio, print, and online. Gaurav is a regular contributor to The National and has also contributed to CNBC Europe, Bloomberg, Financial Times, Gulf News, Banker Middle East, Wealth Magazine, Arabian Business, Dubai Eye, and Dow Jones Zawiya. And introducing our special guest today, none other than the legendary Mohamed El-Erian. Mohamed El-Erian is the president of Queen's College at the University of Cambridge. Since 2014, he's been the chief economic advisor to Allianz, the corporate parent of PIMCO, where he formerly served as the chief executive and co-chief investment officer. He's the chair of Gramercy Fund Management, a columnist for Bloomberg View, and has been contributing editor at the Financial Times. He's also on 2 corporate boards and sits on several advisory committees as well as nonprofit boards. His 2008 bestseller, When Markets Collide, won the Financial Times and Goldman Sachs Business Book of the Year award and was named as the best book of the year by The Economist. His latest work, The Only Game in Town, Central Banks, Instability, and Avoiding the Next Collapse, was published last year and is a New York Times bestseller. From 2012 to 2014, he also headed President Barack Obama's Global Development Council. Mr. El-Erian, it is such a huge pleasure. I've been looking forward so much to having you with us on this session today. You've accomplished so much, and you're someone that we read about and monitor regularly, whether it be on Bloomberg and the Financial Times. And it's so great to be diving into this with you today. Actually, one of your most recent interviews, you were discussing the current situation we're in, Wall Street versus Main Street, markets versus what most Americans and participants in global economies are experiencing on the ground. And you highlighted that, and I quote, a huge amplifier of the inequality trifecta of income, wealth, and opportunity. The COVID shock has pulled the Federal Reserve deeper into policies that are inadvertently worsening wealth disparities. And I was hoping we could actually start off our discussion today by painting the backdrop. Where are we today in terms of markets, in terms of equities, in terms of bond prices, valuations, and what is the economic reality for the person on the ground in Main Street?
So good morning, good afternoon, good evening. Thank you so much for having me with you. It's a huge honor and it's a delight, even at 5 o'clock in the morning. It's a great delight. Look, I think that when you reduce what we're going through right now, you end up with 4 major themes. They explain about, call it 80 to 85% of what we're going through. One is exactly what you mentioned. Inequality. COVID is proving to be what I call the great unequalizer. It has increased the inequality of income. It has increased inequality of wealth. And most importantly, it has increased inequality of opportunity. The second thing we're seeing, not just within countries and around the world, is dispersion. A very big difference in sectors, a very big difference in countries. I used to work at the IMF a long, long time ago. It would have been unthinkable to have a year like 2020 where China may grow by 2 to 3% and the UK may contract by 11%, Spain by 16%. It would have been unthinkable within the advanced countries to have a 4% contraction in the US and a 16% contraction in Spain. But we're having this great dispersion. That's the second theme. The third theme is scarring, the longer term effects. And the fourth theme, which is a result of all that, is what I call the great disconnect. That depending whether you are on Main Street or Wall Street, life is very different. If you're in the financial sector, it's hard to believe that we've gone through a generation-defining moment. US indices are at record high, near record highs, depending on which day you talk about. Bond prices have been very well behaved. The currency markets have been well behaved. Credit spreads, liquidity spreads, any spread you look at is really compressed. And basically, the financial markets tell you there's nothing going on. Everything is fine. Of course, it's a very different issue in the real economy. Europe is back into a double dip recession. The US is slowing really fast. We saw last week's jobless number as yet another indicator. And to reconcile these two things, it's about central bank liquidity. It's about the ample and predictable provision of central bank liquidity. And let me end this first answer by a simple image. When I was at PIMCO and you'd sit in the investment committee room and you would discuss an investment, there would always be a question: who will buy after us? Because you always want other buyers to follow you in. If the answer is the next buyer is a reliable buyer with a printing press in the basement, enormous patient capital, they will stay in the trade forever. And guess what? The price insensitive, they will buy it at any price. That is incredibly comforting for an investor. And that's what central banks do. The QE, which has had massive ripple effects, is nothing more than ample, unlimited purchases of securities at non-commercial levels. And that's incredibly reassuring. And that's what accounts for this massive disconnect.
Mohamed, a very, very warm welcome to our prestigious online webinar today. It's a very, very great pleasure and honor to have you on behalf of Equity. To our partners at AIM Summit, thank you so much for making this happen. And of course, for all our guests who are dialing in and joining in today, a very, very, very warm welcome to you guys. Mohamed, just to pick up on that theme on central bank easing, of course, it's been a very, very major talking point throughout 2020 and in fact, in the lead up to 2020. And I guess the timing is quite interesting because, of course, we have the Federal Reserve convening this week for their last policy meeting of 2020. Of course, amid surging coronavirus cases stateside and unbalanced US economy, which you related to, and unfortunately, no congressional fiscal package to speak of yet at the time of this recording. Many economists see this as an opportunity for perhaps a dovish Fed to expand on that 120 billion monthly bond purchases, or they may even look at adjusting the maturity of these purchases. On the other hand, there's also a school of thought that suggests the Fed may sit on their hands with the hope of putting pressure back on the federal government and calling for more action from the fiscal side, and perhaps waiting until January to decide on additional measures. With so much uncertainty, Mohamed, leading up to this meeting, what are you expecting to come out of this?
So let me divide it between what the Fed should do, Gaurav, and what the Fed will do. The Fed should sit on its hands. The Fed should not be dragged back in because I think there is a lot of evidence right now that when you look at the key phrase that Ben Bernanke put out there in 2010, when the Fed went unconventional, not to normalize markets, but to pursue macroeconomic objectives, he said, quote, "It's about benefits, costs, and risks." And I think most people agree now that the economic benefits of more QE are de minimis, but importantly, the costs and risks are going up. So what the Fed should do is sit on its hands, to quote you. But what the Fed will do is be even more dovish. And to understand that, you've got to understand the mentality of a central bank. The central bank is like a doctor. A doctor never walks away from their patient, never. Even if the doctor doesn't have the right medicine, the doctor will continue to try and treat the patient. And what the Fed is looking at right now is the worst of all worlds. It's this risk in the US, its main focus of a vicious cycle. Public health is getting worse. COVID is basically out of control right now in terms of hospitalization, in terms of death, in terms of cases, over 200,000 cases in the US, over 30,000 in California alone. So there's a public health issue. The economy, as I mentioned, is already contracting. As you pointed out, fiscal policy is not getting anywhere. And what will materialize, and I suspect something will materialize, will be very small. And individual behaviors, people are losing trust in the process. So what you get is risk aversion building up, economic risk aversion building up on the economic pressure. So in a situation like that, the Fed will feel that it has no choice but to do more. So expect the Fed to at least give us very reassuring guidance on QE, basically telling us it's not just low for long on rates, it's long for long on QE. And that will continue this process of providing markets enough reassurance of liquidity to set aside all the other things that are less convenient.
Mohamed, what are your feelings on some of the recent and potentially upcoming changes to the Fed's mandate and approach to influencing markets? Again, recently in August, moving to flexible inflation targeting and effectively abandoning the NIRU as an indicator justification for potentially increasing interest rates in the future, with discussions under the Biden administration of potentially broadening the Fed's mandate to address inequality. Do you think that there are risks as the Fed's mandate changes and broadens, and how do you see this playing out in the markets in the future?
So I think of the Fed as having both the benefit and the risk of being an unconstrained policy actor. And this is really important to understand, that if you're looking around, the Fed is very attractive because the Fed can do things without going to Congress. Not everything, right? But it can do a lot without going to Congress. So the Fed is what people look to as to be not just the first responder, but the constant responder. Now, on the other side, the Fed inherits more and more objectives with the same tools. So what the Fed looks for is to increase its flexibility. So let's talk about what it did in August. In August, it introduced its new medium-term policy framework. And as you pointed out, Zach, the main issue of the medium-term policy framework is more flexibility vis-a-vis the inflation target. That we will no longer aim for a specific inflation target, we will aim for an average inflation target, and we could go well above that number to achieve the average over time. Now, on the surface, that looks like great flexibility. If you sort of scratch your head a little bit, so you say, so let me get this right. the Fed and of course the ECB on the other side of the Atlantic have not been able to achieve the inflation target. And the answer to that is to raise the inflation target. That doesn't make sense, but it does make sense if you think of them as wanting more flexibility. And that's what they're looking for. As they inherit more and more objectives, and now we have 4 objectives in play. You have to understand, we have the dual mandate, employment and inflation. We have a financial stability objective that's out there. And now, as you pointed out, the Fed has stumbled into an inequality. This notion that you run the economy really hot on purpose in order for the trickle down to go all the way down to low income earners. And it works really well with quite a lot of risks. It's not a great policy instrument that's more direct. So should you be concerned? Yes, you should. The last thing you want as the most influential policymaker is to be what I call the only game in town, that everybody just piles everything on top of you, saying you can do this, you can do that, you can do a bit more of this, because it causes 2 issues. One is what Gaurav referred to earlier, moral hazard. Other policymakers don't feel the urgency that they need to do something. And the other thing it causes is eventual ineffectiveness. There's collateral damage in this process. And we should talk about, if you want, what does it mean when a Fed takes on too many objectives with too few instruments?
Mohamed, we definitely like to touch up on that. But before we do, I wanted to also pick your brains on inflation in the US. Obviously, it's not been a very, very big talking point of late. Of course, last week's US inflationary data showed that core CPI in the US was largely unchanged at 0.2%. Year on year, CPI was unchanged at 1.6%. Now, while these are not strong enough and still below the Fed's, their earlier targets of 2%, a closer look would show that the 10-year break-even inflation expectations, as well as the 5-year inflation expectations as priced by the Treasury bond markets, have now reverted to pre-COVID levels, and they're continuing to trend higher. Now, when you combine this with the weakening US labor market, you had addressed this. Last week, jobless claims increased to 853,000, its highest since the summer months, and well above the 716K we had the week before. And of course, in the lead up to the non-farm payrolls from November, which showed that job growth was only at 245K, very well below expectations. Mohamed, are we possibly in a situation whereby stagflation becomes a point to consider?
So it certainly is a growing risk, and it's a growing risk for 2 reasons. One, and there's a lot of uncertainty here. So let me explain what the uncertainty is. First, we have gone through a massive period of disinflation, of downward pressure on prices. And it has to do with our behavior. Everybody on this call, believe it or not, have been a disinflationary force. We are now enabled to do things that we were not able to do before, which takes away pricing power. I call it very simply the Amazon, Google, and Uber effects. Amazon, what do we do in Amazon? We basically disintermediate suppliers. That's what we do. When you order on Amazon, you're taking out someone in the supply chain, and that lowers pricing power. When you Google, you search, you become a much more informed consumer. You become much more price sensitive. You gain, pricing information, which means that you again limit how much you can be charged on price-wise. That's disinflationary. And Uber, which is spreading, which is the notion that you bring existing assets. Cars in Uber exist, but they're not being used efficiently. When you bring existing cars into the marketplace, what you do is you increase supply in a way that limits the price rise. So we have gone through this multi-year effects. I don't know whether these are repeated every year or not. My own gut feeling is there's a limit to that disinflationary effect. So on the supply side, what have been very strong disinflationary winds are going to start to die down. On the demand side, you're having a reaction to increased concentration. we're coming out of this COVID with much more concentrated firms than before. Plus, you have all this massive liquidity. So my own view is there's a really high risk that the markets, even with the adjustments you've noted, are underestimating the longer term, not this year, not next year, but the longer term, from 2022 onwards, the longer term inflationary trends. They really are underestimating the longer term inflationary trends, and that we will see a significant steepening of yield curves as people realize that they no longer have the supply disinflationary. Whether it's stagflation, so that's the inflation part. Yes, I do worry about the deflation part. Whether it's the stag part is going to depend on what comes after the vaccine. It's the scarring element. Scarring is this very simple economic notion that you turn short-term problems into long-term structural issues. Let me give you two examples. Suppose today you are a restaurant, or suppose today you are a small shop that has to shut down because of restrictions. If you go bankrupt, recreating that shop is much, much harder than if you just simply open it up again before that. If you are someone who just graduated from school and university, entering the labor force, and who is unemployed, people may not be hiring you right now because of situation. The longer you are unemployed at the beginning of your career, the more unemployable you become. And that's especially true for people who drop out of high school with few qualifications and skills. So these longer term scarring elements are the ones we have to keep an eye on. If they become material, then yes, yes, we may end up with stagflation. I'm more confident about the deflation side, that we may see 2.5% to 3% inflation in 2 to 3 years, than I am on the stag side, because I think policy can limit the amount of scarring if we get the proper policy response.
Previous periods of significant inflation have often been underpinned by increasing oil prices. Now, oil has obviously had a direct and significant shock to the demand side as a result of shutdown and significant slowdown in global travel that's expected to continue for some time. We here at Dalma Capital, we're based in the Middle East, we're based in Dubai. Many of the people in this audience are also based in the Middle East and consider oil as an important, the price of oil is an important source of revenue, and ultimately it does affect markets here. We've recently seen huge cuts in CapEx, and overall since COVID, the popularity of ESG investments and negative screening has also significantly increased the amount of capital moving towards ESG and clean sectors. What is your outlook for the price of oil in the short, medium, and long term? In the short term or medium term, do you see a potential recovery, and do you see potential risks of high oil prices in the future due to significantly reduced capex that again will result in potentially supply not being able to keep up with demand when demand comes back to normal?
So Zach, this is a really, really complicated issue because you're dealing with so many different variables. Let me say, first of all, if you're a low-cost producer, if you're Saudi Arabia, if you are Abu Dhabi, your outlook is very different than if you're Ecuador and you're a high-cost producer. If you're a high-cost producer, your outlook is pretty scary. It's pretty scary on account of three things. One is that demand is being eroded day in and day out by a move away from hydrocarbon. And that's going to continue. That's not going to stop. If anything, that's going to build up steam. So you have a move away from hydrocarbon, and you're the high-cost producer in that world. That's not great news. Two is that the willingness of a few countries, Saudi, Russia, and UAE in particular, in an OPEC plus context, to give up their market share for you is going to be declining over time. So don't look for others to carry your burden. And then the third element is you are competing with alternative providers of energy. And those alternative providers of energy are going to be subsidized, and you're not going to be subsidized, right? So I do think that if you're a high-cost producer, your outlook is pretty grim right now, even when demand comes back. If you're a low-cost producer, you have time. But that time has to be used to do two things. And you're seeing it happening around the Middle East. One is diversify your wealth. Understand that your wealth that's under the ground can be diversified today to make sure that future populations are as protected as current population have been and past population have been. That's the first thing you do. The second thing you do is ironically, you are also very well positioned for alternative sources of energy. And you can play it from a position of strength. So I do think there's opportunity there, but you have to think very differently from the very strict OPEC mindset, which is we control supply until demand comes back. And this is a repeated game. This is not a repeated game anymore. This is a different game.
Thank you, Mohamed. I just want to give a quick shout out to all our webinar attendees today. Please do get your questions in for Mr. Mohamed. We will be taking them shortly as the webinar progresses. Of course, I can see Manoj Narendra Madnani coming out with a comment on the similar lines. He says the vaccine will be a catalyst for higher oil prices as global mobility is starting to take effect. ESG will require higher capex to convert from petrol to EV. Your cost base defines everything. There will be more efficient ways. Aviation will still require hydrocarbon. In the short term, the prices will be higher. In the longer run, you need to diversify into gas. Mohamed, if I can just switch back to the central bank themes. We've talked pretty deeply on the Federal Reserve. I just want to jump across the pond and talk about the ECB. Of course, last week, they had announced that they would extend their PEP program by an additional 500 billion euros. It would extend the duration of the PEP through March 2022. It would calibrate its TLTROs further by adding 3 more operations in 2021 and further extending it by another 12 months. In an article of yours published in Bloomberg last week, you had said that the recent actions highlighted the active inertia, doing more of the same on the policy front with little or no probability of obtaining a significantly better outcome than before. Now, amidst what seems to be a lack of unity amongst policymakers, it seems now that the ECB is left with little choice and is content to be in a holding pattern amidst a host of upcoming risks, as we know, namely how the pandemic plays out in Europe and its effects on Eurozone growth prospects and Brexit uncertainty. So, Mohamed, in your view, where does the ECB go from here? And how do you see it playing out through Q1 and Q2 of 2021? Now, obviously, what they will do and what you think they should do.
So I think it's a very similar story to the Fed, but even bigger. So if you're in the ECB, you're looking at a double dip recession, you're looking at Brexit uncertainty, you're looking at a currency that is too strong, and you're looking at markets that expect you to do more. If you're facing these 4 things, which is the ECB is facing, you have no choice but to try and do more. And the reason why is you've got to think in terms of risk minimization, or what I call regret minimization. And if you're a policymaker, you're much better off in the short term in doing more and not having it be very effective than doing less, causing financial instability that can then spill back onto the real economy. So in this regret minimization, when you are way, way far away from the world of first and second best, you will continue to do more. But it is active inertia. And for those who don't understand, who haven't come across this term, it is the biggest behavioral risk that successful businesses fall into. If you ask yourself, why did IBM trip up on the eve of the PC revolution? Okay, I would have bet on IBM. Think of it, on the eve of the PC revolution, IBM was the strongest brand in technology, had the biggest research and development budget, was incredibly profitable, and identified the PC revolution as a disruptor to its business model. And it came up with the right policy response. It came up with the right business strategies. That's great work done by Don Sull at the London Business School. But the problem is the minute they tried to implement it, the inertia was so strong that people continued doing what they used to do before. So your mindset is active. I've got to do something different. But you're so constructed that you end up doing the same. I tend to take a non-politically correct example, which is the American tourist in France. They ask a question to a French person in English. The French person either doesn't understand English or doesn't want to understand English. So the French person does like this. The most likely outcome of that setup is the American tourist saying the same thing but louder. So the active part is I've got to do something different. The inertia part is you continue in English but speak louder. So that is what the central bank is doing. And I call it conscious active inertia. And the fault is not of the central bank. The fault is other people with the right policy tools are standing on the sideline. And the right policy tools come down to pro-growth structural reforms and more balanced fiscal policy. People who are able to spend should spend more, but should also be willing, and this is really hard in the European contracts, should also be willing to support others through bigger budgetary grants. So, the ECB is in a position not of its own making, and exiting is not in its hands. This is a no exit paradigm as long as other policymakers do not step in. And what we'll see the ECB doing is just continuing doing more and more of the same, not because it believes, in my mind, that is the answer, but it believes it's the better answer. Than others. It is thinking relative, not absolute. It is thinking, what is the least likely mistake I'm going to make? And if you think in terms of what's the least likely mistake you're going to make, you're going to end up doing more of the same.
Mohamed, we have several questions from several members of the audience that are concerned about the deficits that governments are running. And actually, a few attendees have actually asked about MMT. And again, I know that this is one of the debates that you've engaged in over the years. I'd love to understand what is your thinking on deficits. Can governments continue to run deficits? Governments like the United States that issue their own currency, can they continue to run deficits infinitely? Are deficits actually good? Do we need to worry about passing these debts on to future generations, or should we actually put on the MMT hat and think about governments a little bit differently? I'd love to hear your views on this accumulation of debt, and whether you think the MMT framework is coming more into a mainstream school of economic thought.
So you should all know that I have no idea what questions Zach and Gaurav are going to ask me, let alone what questions are going to be asked in the chat, right? But it's funny that we got to MMT, because look what I have here on the side. This is Stephanie Kelton's great book, by the way. Everybody should read it, not because you're likely to agree with anything in it, but it is an eye-opener. Look, let me tell you what I think MMT has brought to the debate. MMT has brought to the debate that if you're able to issue in local currency, I want to stress that it really matters what currency you issue in. If you're able to issue in local currency, the speed limit on issuance is much higher. You can issue more. You can run higher debt to GDP levels because interest rates are so low. That's number one. Number two is that we have been running a natural experiment where central banks have ballooned their balance sheets and have ballooned their balance sheets in such a way that hasn't caused the sort of damage that we would have thought earlier. And the question now becomes, what should that ballooning fund? Should it be funding the ability of Apple to issue more debt? Or should it be funding government supporting the most vulnerable segment? So that is two very important debates. And I think that MMT has really brought that issue. But like anybody in an argument, when you try to press your case, there is a tendency to go too far. And MMT goes too far in two ways. One is this notion that you can just keep it pedal to the metal as hard as you want until there's actual inflation, right? That you shouldn't preempt on inflation expectation. You should wait till you see the whites of the eyes of inflation. The problem with that argument is there's so many lags in the system that by the time inflation has taken hold, it becomes much harder to counter it. That's the first exaggeration that one has to be careful about MMT. The second exaggeration is it doesn't work for everybody. So the last thing you want is a developing country that has historical problem with inflationary expectations, that issues in dollars, that go out and simply say, you know what, I don't care, I can issue as much debt. Okay, think of Argentina. Do you really want to end up with another debt problem and another inflation, another currency problem? So MMT is of much more relevance to a small set of countries that issue in their own currency. It really is of a lot less relevance to a Argentina, a Venezuela, a Brazil, okay, where they really have to think very seriously about how best to manage that debt stock, because otherwise you end up in a debt crisis, a currency crisis, an inflation crisis. And you need only look at Turkey, you need only look at Argentina to know you don't want to be there.
Mohammed, we have a question from Ibrahim Al-Saifi. He says, Mohammed, thank you for an excellent presentation and valuable insights. Speaking of dispersion and active inertia, what are the implications of the current crisis and the resulting tremendous dollar liquidity to the future of the dollar as a reserve currency and many nations' wealth, especially for all of us here in the Middle East who are traditionally pegged to the US dollar?
Ibrahim, that's a great question. And there's a lot of tendency now to fade the dollar, say that this is it, the dollar is going to lose its reserve currency status. Whenever someone tells you that something is going to go away, the immediate next question you should ask is, what's going to replace it? Because in a global system, you cannot replace something with nothing. So when someone says the dollar is no longer going to be the global reserve currency, the question is, okay, that's fine, I'll give you that. What is the global reserve currency if it's not the dollar? And the answer is, well, it can't be the euro, because the euro actually is in a worse situation than the dollar is. It can't be the Chinese renminbi, because the Chinese renminbi is being issued by a country that doesn't have capital account liberalization, that actually doesn't want that currency to be global. It's looking for something else. It can't be the SDR, because the rate of acceptance of the SDR is quite low. So it has to be the dollar, right? So Ibrahim, we're not going to see the dollar give up its reserve currencies here, but we are going to see a different global system. And to understand that, let's say you're sitting right now in parts of Asia. You bought into a system where the nucleus of the system is the US. The US is the issuer of the reserve currency. The US has the most liquid global markets. So the US actually, you outsource your savings to the US because they are the most liquid markets. And in the middle of that, the US acts as the anchor to the system, But when you're an anchor, you run an implicit contract with the rest of the world. You provide those services and you get incredible, what they call exuberant privileges from doing so. But in return, you run the system responsibly. And what we've seen in the last 12 years is an erosion in the trust that this system is being run responsibly. First, the global financial crisis originated in the United States. And remember, in this system, crises are supposed to be in the periphery, not in the center. And then second, the US went in 2017 from being the champion of free trade to being the most protectionist advanced economy. So the trust in this system, it gets eroded. So what do you do if you're sitting in Asia? You do what China's doing. You start building pipes, small pipes around the system. And these pipes are proliferating. They started by being bilateral payments agreement where two countries settle in their own bilateral currencies and don't go through the dollar. Then it became the BRI, which is a regional arrangement that's extended now as far as Italy, just to give you a notion of it. And this initiative, what the One Belt, One Road, the Belt and Road Initiative, comes with a payments element to it. So what we're going to see is the dollar remain in the reserve currency, but its influence get eroded by all these little pipes that are being built in the system. That's what the global system is going to look like for the next 10 to 15 years.
Actually, just to address the audience quickly, we have 70 questions, so we're not going to be able to get to all of the Q&A, sadly, but certainly keep the questions coming in. We are screening through all of them, and we're looking to cherry pick the questions that we think best go into the discussion. Again, all of these are very great questions, and I wish we could answer them all, but we are running into the last 20 minutes or so of the webinar. Mohamed, you touched upon the role of the US dollar as the world's reserve currency and the impact that that Fed policy and the policy of the ECB, the shockwaves that sends through the world's financial markets. There's several questions about the emerging markets and how negative interest rates in the US or in Europe and potentially in the US might affect emerging markets in the future, particularly negative real rates, and what your outlook is for emerging markets in general, whose markets have not seen the very ebullient recovery that we've seen in the United States.
So, this period for emerging markets has reminded me a lot of the beginning, the opening of Charles Dickens' A Tale of Two Cities. The best of worlds, the worst of worlds. The best of worlds comes from the financial side. Most, not all, most emerging economies have been able to issue debt, ample debt, at relatively low yields. That includes the Middle East, by the way. We've seen a lot of issuance out of the Middle East, and this has been a very, very accommodating environment for debt issuance. We've seen Peru, go to Latin America, Peru able to issue a 100-year bond at a time when its president changes every few weeks, right? And to understand that, it's simply that when you depress rates and take them negative in Europe, you push capital in search of return, and people will go to emerging markets where they feel they can pick up spread. So it's been the best of world on finance, but it's been the worst of world on the economy. If you are the typical emerging economy, you've dealt with lower export demand, you're selling less abroad because the world is buying less. Almost no tourism to speak of, so you've lost tourist receipts. Remittances have been hit, foreign direct investments has been hit, and aid is more uncertain now. That's the worst of world. So you have the best of worlds and the worst of worlds. And for most emerging economy, that has solved into you can forget about the worst of worlds for now because you can continue funding yourself at high rates. Going forward, I think that you're going to see a lot more differentiations. And I call them the I, the L's, the U's, and the V's. Or in other words, in the old days when my daughter was really young and she'd leave me a note, "I love you, Dad," the love would be spelled L-U-V. So what we're going to see is certain emerging economies that are going to have enormous difficulty servicing debt. And you're going to see asset prices go straight down and stay down for a while. You're going to have others where there's going to be an L. So that's the I. An L, where they come down, but they stabilize, and they're really good carry trades in local currency and in foreign countries. Then you're going to see the recovery stories. Some will take time, the U's, and others will happen rather quickly, the V's. And I say that because we are going to have this dispersion where you're going to have actually a lot of opportunities if you understand what the underlying dynamic is. And what do you need for the underlying dynamic? You really need three things. One is very granular analysis. It really is about the resilience of individual names and individual sovereigns. So you need a lot of this credit and equity analysis. Two, you need to understand liquidity. The emerging market asset class is structurally unbalanced. Its dedicated asset base tends to be small relative to the crossover, the people who come in like tourists, invest, but then leave. They're not committed to staying there. So it overshoots on the way up and it overshoots on the way down. So it's really important to understand the liquidity element of that. And then the final thing is to understand is, of course, the policy side. How will policymakers react to these different I, L's, U's, and V's? I get really excited because I think we're entering a period where emerging markets are going to be opportunity rich, but they're going to go from investing in general to being very specific, very granular about how you invest.
Mohamed, just following on that, and it's perfect that we're talking about emerging markets because none other than Mark Mobius, the Indiana Jones of emerging markets, is actually in our webinar and has asked a question to follow on our discussion about MMT. And I actually gifted him recently Stephanie Kelton's book, The Deficit Myth. So I guess he's just gotten into it. And his question is, can the government best allocate capital, or should Jeff Bezos be allocating capital to achieve productivity? They're actually, in the most recent issue of The Economist, one of the things that was highlighted was that the pandemic could give way to an era of rapid productivity growth. But in a market where we potentially have government so heavily involved and being the only game in town, do you have concerns as to whether capital will be allocated towards its most productive means if governments continue to intervene? And how does productivity play into the recovery and the future of markets in general?
So it's wonderful that Mark is on here, and I have incredible respect for him. He really has been and is the pioneer in the asset class. And if you want to talk about granular analyses, there's no one that has shown how that is done more than Mark, who gets on his plane, goes and talks to companies. So it's wonderful to have him there. And I'm glad that he came in after that, the importance of the sort of analysis he pioneered. Look, if we were living in a good world, governments would only intervene where there's market failure. Governments wouldn't substitute for markets, they would complete markets, because market allocation of capital has repeatedly proven to be more effective than government. And ask yourself the question, when you have skin in the game, do you behave differently or not? And most of us behave very differently when we have skin in the game than when we're on the sideline and we don't have skin in the game. So government should step in and only intervene when there's clear market failure. Now, in a pandemic, there's clear market failure. And if governments hadn't supported vaccine development, for example, we wouldn't have gotten vaccines so quickly. If governments hadn't supported the sort of public-private partnership that brought scientists together, we wouldn't have all these other things that are emerging from this awful period that actually are going to serve current and future generations. But you've got to be careful, because we've also learned over time that once government intervene in the economy, it's very difficult to step back, because you can pursue other objectives, not just efficiency objectives, but other objectives. And we're going to go through a period of heavy government intervention. If we had been holding this webinar a year ago, and I would have suggested the levels of deficits that are being run now, if I would have suggested that the US alone would have a combined policy intervention of 30% of GDP between fiscal and monetary, you would have said, I am crazy. But that is what has happened. And we're not going to go back to the old normal that quickly. So we need collectively to stress enormously the composition of fiscal spending. What is this money being spent on? Because unless this money is being spent on supporting productivity and growth potential, it is going to crowd out at some point other things. And I want to go back to the collateral damage of central bank intervention. We all think rightly, because we've been on the sunny side of this, that riding a liquidity wave is wonderful. I live from California. I know, Zach, you come from Southern California. You know what it's like when surfers are on a big wave. They're great. They love it. And the more surfers see other surfers on a big wave, the more other surfers, they'll get on the big wave. And as long as that wave doesn't break, it's wonderful. And that's what we're all living on. But understand, in creating this liquidity wave that we're all benefiting from, asset prices have gotten really distorted. A lot of risk is being taken. Is Airbnb really a $100 billion company? Ask yourself the question. Is Airbnb really a $100 billion company? Well, it is according to the marketplace, but it is because of liquidity. And then the last thing I would say is, the more distorted asset prices are, the more the allocation of capital is, going back to Mark's question, right? So we've got to be careful that in creating this wonderful liquidity wave, it doesn't break into something that we find out that resources have been misallocated throughout the world. And then we don't get the handoff to the high growth, high inclusive, sustainable growth that we need to sustain asset prices, and most importantly, to sustain well-being of this and future generations.
Thank you so much for that, Mohamed. We have so many questions pouring in with so little time left. A couple of questions by some of our viewers. They were asking for some of the books that you have referred. Mohamed had referred the book called The Deficit Myth by Stephanie Kelton. Of course, you can check out both of Mohamed's books that he has written. One is titled When Markets Collide, and the other is titled The Only Game in Town. Mohamed, I was saving this towards the end of the presentation. I mean, these were some of the first earlier questions coming in, and a lot more questions about it. But no webinar would be complete without a quick take of yours on the recent performance of Bitcoin. Very hot topic, particularly in this region. According to your Twitter, of course, you famously dabbled in a bit of Bitcoin. But Mohamed, could you just give our viewers a broad overall approach you take to Bitcoin and cryptos in general? Maybe talk a bit about its potential impact on fiat money and its impact maybe on global central banks. Just more of a broad picture of yours.
Sure. From day one, I wasn't a buyer of either of what I call the corner solutions. There were two corner solutions. There were those who said Bitcoins are the biggest fraud in history. They're gonna not even be around in a year's time. I thought, no, that's not right. You don't quite understand the power of Bitcoins. But then there was the other view that Bitcoin would become the world currency. And I said, no, you have to understand what a currency requires, and Bitcoins cannot deliver that. So I've been in the sort of middle where Bitcoins exist in the ecosystem. They perform a function, but that function is limited by certain things that Bitcoin advocates do not control. And then when it comes to the trading side, I said to myself, I remember when Bitcoins were in the 15 to 19,000, I said, I'm not touching it till it goes below 5,000. And I waited very, very patiently. And then I dabbled, as you pointed out, at 4,000 some, and I sold it the other week at 19,000. And I didn't do this because I have any significant knowledge of Bitcoins. I'm doing this purely on technical analyses. That when an asset class is establishing itself, it overshoots on both sides, right? And Bitcoins are still establishing themselves. They will exist. They will be part of the payments ecosystem. They're not going to disappear. And the underlying technology of blockchain is already spreading in both the private and the public sector. Central banks will have a very mixed feelings towards them. On the one hand, they will gain a lot of insights from how Bitcoins and other cryptos operate. They'll want to understand the underlying technology. They'll be keen to see how it spreads, but they will be very, very careful that it doesn't become a broadly accepted currency, because currencies are an element of economic control that central banks will not give up very easily. And that's why I tell people, it will exist. Take it seriously, understand it, but don't get carried away with it.
Well, Mohamed, this has been such an insightful session. Our hour is almost up. I actually just wanted to ask for our viewers. We've covered so much ground. We discussed central banks. We discussed Europe, the United States, emerging markets. We talked about MMT. We talked about so many topics: cryptocurrencies, central bank liquidity, whether to ride the wave or watch out for the crash. I wanted to understand, what are some of the key takeaways from this session that you think our audience should have?
One is, there's nothing wrong with continuing to invest broadly as long as you understand this is a liquidity wave. This is not a fundamental wave. And if you are willing and able to give up liquidity, only do so when you're convinced there's going to be a handoff to fundamentals. That's one. Two is, don't underestimate the things that haven't served you. So if you were a traditional investor, everything you do has been of no use to you in the last year or so. Okay. Granular analysis really hasn't worked. This notion of I need to find out, okay, where the resilience is, everything has gone up unless you've been really problematic. But don't give that up. Those skill sets are going to be really required, because we are going to go into a much more differentiated world going forward, and particularly so if you're investing in emerging economies. So go back to old tools that are going to serve you well. Third, and importantly, we cannot and should not disconnect financial markets from the real economy. That is a big, big mistake. There's a reason why the financial sector is known as financial services. You serve the real economy. And the 2008 crisis was about disconnecting too much from the real economy. So at the end of the world, I tell people at the end of the day, you cannot be a good house in a bad neighborhood. The neighborhood effects matter. So it's really important to understand how and when this disconnect is going to be addressed. And I want to thank everybody, for the opportunity to be with you and great questions. And thank you very much, Jack and Gaurav. I really appreciate it.
Mohamed, the pleasure is all ours. Again, I just wish we had more time with you today. This has been such an insightful session for all of us. It's certainly guiding our decisions as we go into the end of the year and into early 2021. Sticking to our guns and remembering that markets are markets. I think that you've given us a very sound and salient view in how we can make our investment decisions going forward. Again, I really wanted to thank the AIM Summit team for organizing this, and really thank also Gaurav and the entire team at Equity who made this all possible. If I could just hand over to Gaurav for a moment to give some closing remarks.
Thank you so much, Zachary, and everyone at AIM Summit. It's been a real pleasure. Mohamed, it's been a huge honor for me personally, and it's been a pleasure speaking with you today. A big thank you for your time today on behalf of everyone at Equity Global Markets. And Mohamed, you must take a trip over to Dubai as soon as possible. We'd love to host you, and we'd be very excited to see you here. And to all our attendees today, thank you so much for taking out all your time in joining us today. Thank you for all the questions and all the engagement. And I wish you and all your families a very safe and happy festive period. Over to you, Zach.
Well, thank you again so much. This couldn't have been a better way for us to finish up what has been an exciting year for AIM Summit. Again, while I miss hosting you all at our conferences, it's certainly been a great year of amazing webinars, and finishing really with a keystone, which was the session with Mr. El-Erian. It was such a huge honor. Again, thank you to everyone who's been regularly attending the AIM Summit sessions. We'll be back in January with more of these insightful and useful sessions, or at least I hope you find them insightful and useful in your decision making. We're going to be talking about tech. We're going to be talking about biotech. We're going to be talking about alternatives. So there's a lot more in store. Again, thank you all and happy holidays. Wishing you a happy Christmas, happy New Year, and looking forward to seeing you in 2021. Thank you all.